All right, my friends, so now we're going to talk about the VGSIX, which is the Vanguard Real Estate Index Fund, the REITs. Interesting. I'm telling you, we're putting together, believe it or not, there is a method to the madness here. We're putting together a strategy that goes above and beyond and just simply throwing your money into like the Wellington Fund or the Income Fund of America or the Total Stock Index. You're going to see something that you like quite a bit here. So what I'm doing is I'm playing out, the last episode I did, I used the USA Gold and Precious Metals Fund. Vanguard has his own Precious Metals Fund. I'm just familiar with USA, not that familiar with Vanguard, so do whatever you got to do. But we're putting together pieces, or building it, cornerstone by piece, brick by brick, to see what we can do to avoid the insanity that was the beginning of 2001 and 2, then again in 2008. And maybe we can escape that with our shirt still on, with our income intact. I don't know. Let's find out. So don't forget to subscribe down below, my friends. 2008-19's here. We need you to subscribe. And, of course, thumbs up and comments. VGSIX. So let's dive right into this. So remember, we're going from 2001 to 2017. And just to reiterate why, is simply because 2001 and 2 were the beginning, I should say the start of this century, were bad. No other way around that. So we want to do the sequence of return risks, looking at, I hate to say safe withdrawal rates because I'm not really doing that here. But then we're going to pull 5% a year off. Regardless of the portfolio value, we're going to pull 5% a year off and see how we shake out. Other videos I'll do where I do 5% adjusted each year with inflation. So we'll have an increasing amount of money we're pulling off the portfolio, and we'll see how that shakes out. So let's take a look at this, guys. So here's VGSIX, and let's see what the numbers look like. So in 2001, it was up 12.35. So 5%, basically start with $100,000, times that by 1.1235. That equals that. We take 5% off the portfolio, which is $5,600. So now what we do is we take that minus that, equal, what do we do? We take this. We take our money off, that minus that, plus or times the 2002, which was up 3.75. It gives us that, and we take 5% off that, and you can see where I'm going. So again, take $100,000, we gives us a certain rate of return. We take 5% a year off that net result, so $100,000 times 12.35 equals that. Takes 5% a year off that, which is $5,600. Subtract 112, 350 minus 5617, times that by the following year's rate of return, which is 3.75, gives us that, and we just go back and forth and back, and it's got all my Excel spreadsheet. So in 2002, we're able to take 5,500. Now the reason why this isn't in red is because actually the portfolio was up that year. I only put it in red when the portfolio was down. So even though our income dropped off, the only reason our income dropped off is because our portfolio only grew at, in this case, 3.75. So it grew less than the rate of return of what we're pulling off. Because remember, we're pulling 5% a year off. So if the portfolio did not grow as much as our 5% distribution amount, we're still got to give it a green because it's still in the positive. It's not in the red. In fact, the Real Estate Investment Trust only had 2 years of down years. That's it, since 2001. You're not an incredible performance, but not too shabby. So here in 2006, this guy was up 35% in 2006, but also got knocked around pretty heavy in 2007, which, for you who are unaware, 2007 was beginning of the bear market. That's when the real estate people were getting hammered like crazy, and it just flowed over into the stock market, because what happened was the leverage that a lot of these banks were allowing, 100% loans, loan to value with no ninja loans, no income, no assets, or a job that's called a ninja loan. And so all these banks were leveraged like crazy. I remember getting stuff from USA that said, hey, you can borrow. I don't think they're quite saying 100% of loan to value. I don't think so. But I remember they're saying basically just sneeze on this application, we'll give you 100% loan against your current appraised value. It was nuts. And of course, appraisals were going through the roof. I remember it was like yesterday. Now the problem was that wasn't felt in the market until 2008. But in 2007, the real estate investors were getting crunched. I'll never forget, I had a lady in 2005, I think, took money from her IRA, paid the 10% penalty plus taxes to invest in a lake in Virginia. Lake Anna? That was Lake Anna. Smith Mountain Lake. She's investing in real estate in Smith Mountain Lake, saying it was a non-lose. She took all her money out to invest in this real estate stuff. And I don't know what happened to her, but I'll never forget that. And I can almost assure you she's working again, that's for sure. And she thought she would not have to. So 2007 was bad for REITs, so certainly bad for real estate investments as a whole. It was down 16.46. 2008 was down almost identical as the total stock index, 37.05. So here we went from 241 to a little bit less than half that. Our income went from 12,000 to half that, less than half that. 2009, we had a pretty good year, up 30%, 29.58. 2010, 28.3. And we've basically been middling for the last 3 years. 2017, 4.83. 2016, 8.34. And 2015, 2.2. So we haven't done much, but we've maintained 11,000, 11,000, 11,000, 11,000 without really a whole lot of volatility. We maintained 238, 231, 238, 237. So that's not so bad. I mean, we got at the end of the day, we got $225,000 in our portfolio. At the beginning of 2018, we got $155,000 that we took out as cash. So the Vanguard Real Estate Investment Trust, I mean, it held up well. I mean, we have 2 down years and pretty substantial. Don't get me wrong. 2007 and 8, we're down 16.46 and 37.05 respectively. But I mean, even after 2008, you still had more than you started with, and you had taken all this money out on top of that. That's not a bad place to be. I mean, you're still clocking in 5,700. Now, in 1 year, did we ever get anywhere near below 5% on the initial investment? No. So we never dropped below $5,000. Nope. The closest we came was right there at 5,500. So that's the Vanguard Real Estate Investment Trust. Interesting, eh? What role would that play in a portfolio? I don't know. I'm going to have some answers for you, so stay tuned. Next time, we're going to go to the Vanguard High Yield Bond Fund. I had some requests from folks asking me to look into these, and I did while I was on vacation in Frisco, Texas. I was able to concoct a lot of numbers and stuff, and I'm excited to show it to you because I think it's interesting. It's kind of changed my perspective a little bit other than the keep it simple stupid. I love keep it simple stupid, but I'm going to show you a way you can keep it simple stupid, but maybe with a little more of a defined retirement planning scenario than just going with a simple mutual fund and hoping that guy or the lady who runs it knows what they're doing. So we'll see. So stay tuned, subscribe. We'll see you next time. Thanks, guys.